Welcome to the Explainer. So if you've been glaring at the markets today, you are probably staring at what feels like a cinematic sea of red. We just witnessed this massive, aggressive market reversal right before the closing bell. And yeah, it has a lot of people panicking. But as we know, where there's panic, there's usually incredible opportunity if you know exactly where to look. Today we're breaking down the source data from this heavy sell-off to figure out the macro triggers, and then we're going to pivot directly into the micro strategies that you can use to capitalize on it. Let's get into it.
So here's our roadmap for today. We're looking at 1. The big market reversal. 2. The new Federal Reserve. 3. Buying the growth dip. And finally, 4. Netflix's trillion-dollar trajectory.
Section 1. The big market reversal.
Okay, let's dive right into this. The last 30 minutes of the trading day were, frankly, absolutely brutal. We really need to face the visceral reality of this drop to understand the landscape we're dealing with. The sell-off was steep, and it spared almost no one across major tech and retail sectors. You look at Elf Beauty, it tumbled 7%, kind of trying to climb back on the shelf, but just getting pushed right back off. Broadcom, which has been one of the absolute hottest stocks on the market lately, suddenly went ice cold, dropping over 5%. And even the Titans weren't safe. You know, Microsoft, a literal market bedrock, took a heavy 4% hit.
But amidst all this carnage, there was one surprisingly amusing survivor noted in our sources portfolio: the Cheesecake Factory. I'm serious. While the rest of the market completely tanked, this single stock just kept marching upward, yielding a massive cumulative profit of $112,000. I guess whether the market goes up, down, or sideways, people still absolutely need their cheesecake. But jokes aside, one green stock doesn't make a market. We really need to look at why everything else is flashing red.
Section 2. The new Federal Reserve.
And that brings us to the root cause of all this. The market despises rate hikes with a fiery passion. And right now, rate hike fears are absolutely in overdrive. Our source data highlights that several key figures at the Fed are pushing for higher rates before the year even ends. This completely shatters the previous expectations of, 3 to 5 rate cuts this year. In fact, the conversation for rate cuts is now being pushed all the way out to 2027. But what's even more concerning for the stock market is this psychological threshold of a 7% yield on treasuries. Historically, as you probably know, new investors are taught to expect about an 8% average return in the stock market. Well, if a risk-free treasury approaches a 7% yield, investors start pulling their capital out of stocks because they're fearing the risk just isn't worth that shrinking reward.
This actually ties into a massive ideological shift at the central bank. We're transitioning from the old Fed era, which, if you remember, was characterized by forward guidance, dot plots, and a constant, highly relevant presence in the news cycle. Now, we're moving to the new Fed era, under Kevin Warsh. The current strategy outlines a master plan to basically fade the Fed into the background. Warsh is stepping away from interventionist monetary policy, stripping away those beloved dot plots, dropping forward guidance entirely, and returning to traditional, market-driven economics. The mindset is, we need to raise rates, you raise them. We need to cut them, you cut them. Simple as that. But this lack of handholding is creating some major short-term uncertainty. And as we just saw, the market is reacting violently.
To really understand the gravity of this shift, we can look to legendary hedge fund manager Stanley Druckenmiller, who actually served as a partner and a heavy influence on Kevin Warsh. Druckenmiller has been incredibly critical of the previous Fed's actions. He actually called their easy monetary stimulus the most radical policy since World War II, warning that it risked creating massive, dangerous asset bubbles.
Druckenmiller even used this great football analogy to describe the 2024 rate cuts. He stated the Fed was basically fumbling on the 5-yard line. By cutting rates when inflation was still a lingering threat, he argued, they risked reigniting inflation and setting financial conditions on fire. And this exact critique is the ideological foundation driving this new, strict, non-interventionist Federal Reserve. They absolutely do not want to fumble the 5-yard line again.
Now, what's really interesting about this is the massive contradiction we're seeing right now. Despite Warsh's stated goals to shrink the Fed's influence and balance sheet, the balance sheet has mysteriously increased by $200 billion since December. I mean, during the pandemic or the Great Financial Crisis, massive emergency injections made total sense. But without an obvious global emergency right now, this $200 billion increase raises some serious questions about what exactly is happening behind the scenes. And that's adding a whole other layer of volatility to the markets today.
Section 3. Buying the growth dip.
Okay, let's completely shift gears here for a minute and focus on an energetic, optimistic financial strategy. Because honestly, where there's volatility, there are phenomenal buying opportunities. I want to pose this directly to you. What are the absolute best stocks to buy on these massive red intraday market drops? When panic sets in, what should your instinct really be?
Well, the amateur impulse, the natural human instinct, is to run straight to safety stocks. People think, okay, regardless of what the Fed does, people still need chocolate from Hershey, groceries from Kroger, and burgers from McDonald's. And while that's totally true, buying safety stocks during a massive dip isn't actually where the big money is made. The logical, high-upside strategy is to target heavily beaten-down growth stocks. We're talking about scooping up steep discounts on fundamentally strong tech companies like Meta, Shopify, and AMD when the rest of the market is just throwing a tantrum.
And this brilliantly illustrates how historical data proves the strategy out. Buying tech during periods of peak volatility yields colossal returns. Just look at this timeline of what our source calls steal deals. In the pure panic of late 2022, you had Palantir trading around $7 a share, a position that later surged nearly 1,700%. Meta was picked up at $88.94 and Amazon at around $82. Even more recently, aggressive buying into AMD during periods of intense tariff drama yielded millions in cumulative profits. So the big takeaway here? When the market is terrified, that is exactly when you buy growth.
Section 4. Netflix's trillion-dollar trajectory.
Which brings us to the micro application of this strategy today. Let's zoom in on a highly specific equity deep dive that our source executed right in the middle of this market drop. Today, a massive, fresh capital injection of over $60,000 was deployed directly into Netflix. And this wasn't just some random panic buy. It was executed specifically because Netflix perfectly fits the profile of a fundamentally sound growth stock experiencing a macroeconomic discount. So let's look at why.
First off, Netflix's fundamentals are absolutely stellar right now. In their latest quarter, revenue grew by an impressive 16%. Their operating margin sits at a highly profitable 32.3%. They generated over $5 billion, yes, billion with a B, in free cash flow, and they post back-to-back A-plus graded income statements. When you see a macro market drop like we had today, a fundamentally dominant company like this presents a beautifully calculated opportunity.
So the crucial point is that beyond the raw numbers, Netflix has been executing some brilliant strategic maneuvers regarding its capital. Recently, they orchestrated a genius maneuver regarding the Warner Bros. Discovery deal. By just walking away and letting Paramount take the deal, Netflix pocketed a massive $2.8 billion breakup fee, literally for free. But more importantly, they avoided chaining their balance sheet to a decade of bloated debt, which keeps their financials incredibly clean, lean, and highly competitive.
Let's move to the risk-reward matrix and see how this builds directly into their future valuation. This matrix maps out the projected compound annual growth rate, or CAGR, for Netflix through 2030. In the bull case, assuming 13% revenue growth, we're looking at roughly a 30% CAGR. The base case offers a fantastic low to mid-20s% return. But pay close attention to the bear case at the bottom. Even with highly conservative estimates of just 9% revenue growth and a lower price-to-earnings ratio, the projected CAGR is still an incredibly strong 15 to 21%. When the absolute worst-case scenario still yields those kinds of numbers, the risk-to-reward ratio becomes just incredibly compelling.
Which leaves us with this final provocative thought. With a pristine balance sheet, brilliant corporate maneuvering, and highly conservative models projecting massive returns, will Netflix join the trillion-dollar boys club in the early 2030s? The math certainly points in that direction. So, the next time the Fed sparks a sea of red, I challenge you to look past the short-term panic, rethink your instincts, and ask yourself how you can capitalize on the next big market drop. Thanks so much for joining me on this explainer, and I'll catch you next time.